Hi, everybody. David Blaine here, CEO of BlueSky Wealth Advisors. Thank you for joining us today. Today, I'm going to be talking about the implications of rising interest rates on your portfolio. And before I do, as I've been telling people, soccer season has started here in North Carolina, and I coach some of my kids' soccer. So you have to pardon my scratchy voice, but I think we can get through this. This is a very important topic. A question that a lot of people are asking is, what about these rising interest rates? What does that implication have on my portfolio? So that's a great question. So the first thing we'll do is just kind of talk about, well, where are we? So yields have been rising. As I talk today, I'm going to be mostly talking about the 10-year U.S. Treasury yield. So what is that? That is the interest rate that you can receive if you invest in a 10-year Treasury bond. Right now, it's about 1.6%, and it's gone up significantly since February. It's gone up a lot as economic activity is returning, the vaccine rollout is going well, and things like that. We've seen the interest rates rise. But that is what it is. If you own a Treasury bond, it matures in 10 years, the U.S. government will pay you 1.6% over that 10 years, and it's considered a risk-free rate, such as there is such a thing. It's just what it's called. Whether it is risk-free or not, that's another question we can debate in another video, but that's what it's called, the risk-free rate. Where we come from, I thought it'd be useful to put that in some context for, throughout history. We have data going back in the U.S. to 1798. The first U.S. bank, America's first bank, was chartered or created, whatever. And interest rates at that point were 8.1%. So 1798, interest rates were about 8.1%, and it caused a recession shortly after. The next big event, if we look at 1869, after the end of the Civil War, rates in the U.S. were, with the economy booming and things like that, rates were around 4.2%. World War II, at the end of World War II in 1945, rates plummeted to 1.7% as government debt, skyrocketed to finance the war. Rates were about 1.7%. So really the last historical time until the modern era where we've seen rates so low was after World War II. And what's interesting is they rose from 1945 all the way to 1981, almost 40 years of rising interest rates, where they peaked out in 1981 at 15.8%. How'd you like to invest in bonds at that point? In fact, I remember when I first started as an advisor, started the company back in '99, there were still people that owned long-term treasuries. Obviously, the 10-year would have matured by then, but people still owned 30-year treasury bonds that were paying these massive interest rates, and they lived on the interest income. But anyway, so since 1981, rates have been on a downward slope. In the Great Recession, 2003, they bottomed out somewhere around 2.3%. And then in 2016, they got down to about 1.5, and the all-time low was August of 2020, last year, sort of the height of the pandemic. They got down to 0.5%. So can you imagine giving your money to the government for 10 years and getting 0.5% interest? Well, what's interesting about that is that's about 1% more than you're getting overseas. Some of the European banks actually pay negative interest rates. How that's even possible, people get really confused thinking about that, but it is possible. You actually have to pay the bank. What is negative interest rates? You as a consumer have to pay the bank to keep your money in the bank. And I saw an article recently, people in Germany were getting a little bit tired of paying money to the bank to keep their money in the bank, and they're looking for alternatives. But anyway, there is such a thing as negative rates. But here in the US, our lowest rate is 0.5% in August of 2020. And so now we're up at about 1.6%, rising interest rates. So how does that work? Best way I think of it is a seesaw. I know when I was a kid, there was these things on the playground called a seesaw. I think they're probably illegal now because people might get hurt on them and pinch their fingers or whatever. But it was this device where you would sit on one end of it. It was like on a fulcrum, and one kid would sit on one end and the other, and you'd bounce up and down, or your parent would push on one end, and if you really did it hard, the person on the other end would kind of go flying. Well, that's the best way to describe interest rates is if you're out on the end of the seesaw, interest rates, if rates go up, the price goes down, and it goes down fast. If rates go down, price goes up, and it goes up fast. If you're in the middle of that seesaw, so short-term rates, you're not moving around so much. So that's what's happening. If you have short-term bonds, the rise in rates has not affected you that much. If you have long-term bonds, you get kind of whipsawed out there at the long end of the spectrum. So we typically, short-term bonds or, anything, 1 to maybe 3 years. Intermediate term bonds are generally, 3 to 10. Anything beyond 10 years is considered a long bond. Certainly, if you're out in there in the 30-year range, that's a very long bond. People break that up differently. That's not a hard and fast rule. So why do we have interest rates rising? Well, number one is interest rates are, despite what you hear, the Federal Reserve only sets the overnight lending rate. When you hear, oh, the Federal Reserve raised interest rates or lowered interest rates, they're setting the overnight lending rate that banks and the Federal Reserve can borrow money at that rate. And so the market sets the interest rates. Treasuries are put to auction and people bid on them. Large institutions typically buy the bulk of treasury bonds, and so they're set by the market. So we passed this $1.9 trillion stimulus bill. Where's that money come from? Well, yes, it is printed, and we could get into that in another interview, but basically, to finance the federal government spending, they issue bonds, treasury bonds, and they put those out to market, and your larger institutions bid on them, $1 billion here, $100 billion, whatever. And so there's an estimated interest rate, but the ultimate interest rate is determined by who wants to buy it. And so if people demand more interest, the interest rates rise. If people don't require a high interest rate, they'll bid low and the interest rates go down. So that's how the market rate for treasury bonds is set. And so rising interest rates generally up to a certain point signals economic activity. Where we are now is things are looking up. People are investing in stocks, people are investing in businesses, things like that. And people don't want the security of the government bonds as much. And so the government has to pay more interest to entice people to purchase the government bonds. That's kind of how it works. There's also a component of inflation in the bond return. So a bond return is a component of how much economic activity do we think there's going to be, plus how much inflation do we think there's going to be. And that equates into what people demand for an interest rate. Now, it can get out of control, like in the 1980s, when interest rates went up to 15%. Obviously, that's not a good thing. That was just killing the economy. But to a certain point, and this is where the sort of the art of investing comes into play, is up to a certain point, rising interest rates are actually a positive thing for the economy. They signal growth, they signal optimism, and things like that. So it's not necessarily a bad thing. Now, for the federal government borrowing so much money, obviously we don't want interest rates to go too high or the payments will become unaffordable. In fact, Janet Yellen, the new chairman of the Federal Reserve, said something the other day that I just had to laugh. She said, it doesn't matter the amount of the debt, it's whether we can afford the payment. And all I could think of was a used car salesman. When you go to buy a used car, like, oh, don't worry about the price of the car, the payment. Can you afford the payment? Anyway, I think, she didn't really mean it that way, but it was just kind of funny to hear that, that she would say it doesn't matter the amount of the debt, it's whether we can afford the payment. But anyway, so rising interest rates up to a certain point indicate positive economic activity.